Welcome to TMS Insights at the start of October after what's been a really rocky ride on the markets for the September quarter. Ben Clark and Jeremy Hook bringing you the updates. Ben, really, mate, a rocky time, wasn't it?
Sure was, Jeremy. I mean, we saw a lot more volatility on our market than a lot of offshore markets. And, you know, the biggest issue that's immediately concerning the market, of course, is what's going on in China. And our share market and economy, I think, largely is being thrown in as a proxy for China. Mm-hmm. And offshore investors are sort of buying and selling our market with the, bad economic data or China's not so bad sort of news. And that's seeing a lot of volatility across the market. Of course, a lot of companies won't be affected by what's going on in China, but because they're part of the ASX 200 index, which the offshore sellers are selling, that's still creating a bit of weakness in their share prices.
Yeah, so in gross numbers, we saw a quarter decline of 8%, which followed a 7% decline for the second quarter. The year-to-date is now a -1. So, again, across a lot of client portfolios, there's a lot of red ink that wasn't there 3 or 6 months ago. And for no material changes in a lot of those companies.
No, definitely not. I mean, we've just been through earnings season. I think we gave our thoughts on earnings season. You wouldn't say there's a lot of earnings growth out in the general market, but not all stocks have come off. There have been some that have held up pretty well, but I think it really just points to that nervousness. But stocks now, I think, this 5,000 sort of level seem to have come back to a pretty strong level of support. Dividend yield really kicks in at these sort of prices. And, famous last words, but you've hopefully sort of seen the last of it. But, I think the commodities area of the market still is really shaky.
Well, in talking about what's changed since we last brought the update, the commodities stories got worse. Obviously, Glencore was a big story over the last week or so. And there are certainly some worries in that.
Yeah, absolutely. I mean, Glencore, I think at one stage was a bigger company than BHP.
It was, yeah.
So it still is an enormous company. And it's a company that, from the outside looking in, seems to have way too much debt. And for whatever reason, bondholders have suddenly got very concerned about that debt and, in turn, debt at other resource stocks. But fortunately, we've got very, very little exposure to resources across our clients' portfolios. But the market does. Our market still has a huge number of resource stocks, pays a big part of our index. And so I think, it's one of the reasons why our portfolios are holding up a fair bit better than the general market. But there doesn't seem to be any ends in sight. I guess the concern is if something did happen at Glencore or the counterparty risk, and that could flow into some other areas.
It looks to me quite similar to Rio, which entered the post-GFC environment with too much debt, had asset sales, recapitalisation, but gets through it, survives as a lesser company. The other thing that's really changed is the US interest rates decision. We gave a fair bit of foreshadowing there of what might have come from Janet Yellen. Wasn't necessarily what I expected, a deferral in any interest rate rise and the associated commentary, but it's had a profound impact on the markets and hasn't necessarily been good or settling.
No, I mean, it should have been good. US leaving rates on hold, and it could be till 2016 now, should have been good news for the equity markets, but they really messed it up in terms of the language they used to describe why they left rates on hold. And it actually left the market to think, what are they seeing that we're not? And why didn't they lift? Is there something out there that we should be concerned about? And that in turn fed into more volatility as the China sort of economic data went south and has created some concern in markets. But hopefully the Fed will try and soothe that down. And I still think it would be better just to get on with that rate rise, even if it's just the token one, and push out the next one for a while, but just to get into that zone. Because the evidence is in the last 4 rate rise cycles, equity markets have rallied for the first year, and because people got more money in their pockets, they go out and spend, and it actually accelerates the economy. So it's not a terrible thing.
And the US economic data is good. It was very much a decision based around concerns about emerging markets, and that's a very interesting departure in terms of domestic monetary policy in the US. This week, obviously, energy's been under pressure for some time, but a significant announcement in our local market from Origin about a rights issue.
Yep, and so we were on the conference call yesterday. Origin, because of the oil price, which has now fallen about 60% in the last 6 months. It's been another pretty horrible part of the resource complex. Their APLNG project is now sort of profitable but only just. And I think they're of the view, particularly after what's happened with Glencore, and we've seen very suddenly some ructions in debt markets, that they need to get that level of debt lower to make sure that they can withstand any sort of market environment. And Grant King was pretty clear on the call, saying with what the measures we're doing, even at a $15 oil price, we will still be an investment grade from a debt point of view. So they've reset their balance sheet. We suspected this might happen,
yes.
And we believe it's a great opportunity to average down into the stock. You know, it's a 4 for 7, so you'll be able to buy 4 new shares for every 7 shares you own at $4. It reminds me, Jeremy, a lot of the Wesfarmers capital raising, because I think there's
the Coles acquisition.
I think the businesses in Origin, the core business is very good and stable. The APLNG business, I think, will turn out to be a great business over the next 20, 30 years. But it's unfortunate that they've got too much debt at a time the market started worrying about debt and the oil prices collapsed. And so, Wesfarmers raised at $13.50, back in the day, and that was one we really went into hard. And look, time will tell. But I think buying Origin at $4, you'll look back and say that was a great opportunity.
Yeah, no, interesting. And now it's sort of getting a picture of what's coming up as we go into the final quarter of the year. October used to be a tricky month. I think September's more or less become that over the last decade or so. We don't get a lot of information through the month of October, and we do hear bank reports at the start of November. So full year results from NAB and ANZ, Westpac, they'll be coming to us. In terms of the market at the moment, Ben, value in a lot of areas, but some of the smaller stocks probably looking more interesting than the top end of the market.
Yeah, I think that's probably right. I think, a lot of the blue chip stocks are still got that sort of premium PE based into them. And if you go to that next level of mid caps, and I would also say that what's been interesting is that quite a lot of mid caps have actually held up quite well in terms of their share price. They haven't been the victims of the index selling that the blue chip stocks have been. And I think there's more earnings growth.
There's more earnings growth. That's the key thing. So, and we did say that last time, that the reality of the top end of our market, dominated by 4 banks, 2 resource companies, a telco and 2 retailers, there is not a lot of earnings growth there. No. They're not bad companies, they're good companies, but they're not growing rapidly in an earnings sense. But there is a good earnings growth in the next tier, the mid cap and small cap area.
Absolutely. And I think that's where the opportunities sort of lie at the moment, because I think there are businesses that are smaller that are able to, carve out that niche for each other and themselves, and we've spoken about a few of them, on these videos. Like one as an example, Invacare, under $11. I think over the next decade that will become a much larger business than it is today. Nothing has changed with the fundamentals of that company, but its share price has come off quite substantially. Yeah. And, so that's where I see, the buying sort of opportunities at the moment.
Excellent. All right. Well, that's all we've got time for on this edition. We'll be back again next month.